Good morning. Let me start with the headline. We are in a deflation regime. 95% confidence. The 10-year yield is falling. Growth concerns are dominating inflation fears. And a historical parallel that keeps coming up in our models is March 2020 liquidity crisis dynamics, not an inflation scare. This is not a garden variety growth scare. It is a liquidity-driven growth scare. The distinction matters because the policy response function is different. Central banks have unlimited tools to fight deflation. They have used them before. They will use them again. The asymmetry here favors positioning for the policy response, not chasing the downside. Let me walk you through the institutional playbook for this regime. Equities, underweight. Earnings compression risk is real when the denominator in the discount model is falling because growth expectations are collapsing faster than rates. You do not want broad beta here. You want quality, cash flow, and duration hedges. Bonds, overweight. This is the regime-aligned trade. Long duration benefits from falling yields and the flight to quality bid. The long bond ETF, TLT, is the cleanest expression. We have a moderate conviction long structured in the trade ideas. Gold, neutral. The inflation premium is being stripped out. Gold works as a currency debasement hedge, not a deflation hedge. It can rally on safe haven flows, but the driver is different. Position sizing should reflect that nuance. Crypto, underweight. Risk-off dominates. Bitcoin correlates with risk assets in a liquidity crunch. The FOMC meeting in 12 days is a high-impact catalyst for crypto. A dovish pivot would spark a risk-on rally, but the base case is regime continuation. Bitcoin at 64,556, down 0.25% on the week, sitting at the 50-day EMA. Ethereum outperforming at plus 1.4%. Solana lagging. The 50-day EMA breakout narrative in the crypto press is real, but the macro overlay says wait for the Fed signal. Dollar, overweight. Deflation strengthens purchasing power. The dollar benefits from the flight to quality and the carry advantage as global central banks ease. Commodities, underweight. Demand destruction is the dominant force. Energy, industrial metals, they need global growth. They're not getting it in this regime. Utilities rotating into consumer discretionary. This is an early cycle signal. Consumer spending confidence is rising at the margin. Utilities have been the defensive hideout. Money rotating out of utilities into discretionary suggests the market is pricing a soft landing or policy pivot, not a hard landing. Moderate conviction. Watch consumer spending data and credit card spending data for confirmation. Conviction, high. Lucid showing exceptional relative strength today at plus 28.79%. It is outperforming the vast majority of its peer group. The FOMC meeting in 12 days is a medium impact catalyst. A dovish pivot would be rocket fuel for a high beta, pre-revenue EV name. Entry, $5.83 to $5.95, current area. Target, $6.84, 15% continuation target. Stop, $5.47, 8%, thesis invalidation. Time frame, 2 to 4 weeks. Risk reward, 1.9 to 1. Risks, broad market reversal dragged high beta names regardless of idiosyncratic strength. Position sizing is critical. This is a high beta name. Size it as a satellite position, not core. Conviction, medium. This is the regime-aligned allocation. In a deflation regime with 95% confidence, long duration is the textbook play. The March 2020 parallel holds liquidity crisis dynamics favor long treasuries. ETF approach removes single issuer risk. Entry, scale in over 2 to 3 sessions. Do not chase. Target, 10 to 15% gain over 4 to 8 weeks if regime holds. Stop. Exit if regime signals flip. Watch VIX, DXY, gold relationship for regime change signals. Time frame, 4 to 8 weeks. Risk reward, 1.5 to 1. Risks, regime reversal is the primary risk. Use the stop. ETF diversification cuts both ways. You get broad exposure, but no alpha from security selection. In deflation conditions, JEPI provides equity-like participation with a covered call overlay reducing downside. Monthly dividend income, lower volatility than SPY, appropriate for investors wanting income and capital preservation. Entry: any pullback of 1 to 2% from current levels. Target: capital preservation plus yield, 4 to 7% annualized. Stop: no hard stop. Review only if macro regime changes significantly. Time frame: 3 to 6 months. Risks: opportunity cost if markets rally strongly. Interest rate sensitivity for bond-heavy portfolios. JEPI holds equity and writes calls, but the equity portion correlates with rates. On the crypto side, Bitcoin at 64,556, down 0.25% today, ranking third of 4 in its peer group. Ethereum up 1.44%. We are operating in a deflation regime, 95% confidence. Historical parallel, tracking March 2020 liquidity crisis dynamics. This is a well-established regime, likely to persist near-term. The evidence is unambiguous. The 10-year yield is falling, growth concerns are dominating inflation fears, and the dollar is strengthening on purchasing power rather than rate differentials. This regime dictates a specific playbook. Equities are underweight. Earnings compression risk dominates. Bonds are overweight. Deflation benefits fixed income duration. Gold is neutral, stripped of its inflation premium. Crypto is underweight. Risk-off dynamics dominate digital assets. Dollar is overweight. Deflation strengthens purchasing power. Commodities are underweight. Demand destruction is the dominant force. Sector rotation is signaling a moderate shift. Utilities rotating into consumer discretionary. This is an early cycle signal. Consumer spending confidence is rising despite the deflationary backdrop, a divergence worth monitoring closely. Let me walk through the asset class playbook with specific positioning for each investor archetype. For the aggressive trader, LCID long. High conviction. The name is showing exceptional relative strength at plus 28.79% today, outperforming its peer group decisively. Entry zone 583 to 595, current area. Target 684, 15% continuation target. Stop at 547, 8% thesis invalidation. Risk reward 1.9 to 1. Time frame 2 to 4 weeks. This is a high beta name. A broad market reversal drags everything down. Size accordingly. For the moderate allocator, TLT long. Medium conviction. This is the regime-aligned play. In a 95% confidence deflation regime, long-duration treasuries are the canonical allocation. March 2020 dynamics, liquidity crisis dynamics, favor duration. The ETF wrapper removes single-name risk. Entry: scale in over 2 to 3 sessions, do not chase. Target 10 to 15% over 4 to 8 weeks if regime holds. Stop. Exit on regime flip. Watch VIX, DXY, gold relationship for regime flip signals. Time frame 4 to 8 weeks. Risk reward 1.5 to 1. Primary risk is regime reversal. Use the stop. ETF diversification cuts both ways. Reduces idiosyncratic risk but dilutes alpha. For the conservative allocator, JEPI long. In deflation, covered call overlay provides equity participation with downside cushion. Monthly income, lower volatility than SPY, appropriate for income-focused capital preservation. Entry on any 1 to 2% pullback. Target: capital preservation plus 4 to 7% annualized yield. No hard stop. Review only on significant regime shift. Time frame 3 to 6 months. Risk: opportunity cost if markets rally sharply. Interest rate sensitivity in the bond sleeve. Now, the 3 forward scenarios for the next 2 to 4 weeks. Bull case, 40% probability. Fed signals dovish pivot. Earnings beat across key sectors. Geopolitical de-escalation. S&P target 79.51 to 81.78. Works: high beta growth, crypto, small caps, cyclicals. Base case 45%. Current regime persists. FOMC July 29th and CPI in 5 days are the catalysts. Markets digest recent data. S&P target 7421 to 7800. Works. Regime-aligned positioning as outlined. Long duration, covered call equity, selective high beta. Bear case, 35%. Hot CPI forces hawkish pivot. Earnings disappoint, credit event, or geopolitical shock. S&P targets 68.15 to 71.18. Works. Gold, short duration bonds, VIX calls, dollar long. Now the deep dive segments. First, UTI. Down 13.5% today, 17% on the week. It is the worst performer in its peer group today. The peer group is mixed, but UTI is the clear laggard. Key drivers. Interest rate sensitivity, earnings disappointment. Last quarter missed by 55%, and sector rotation out of rate-sensitive names. The macro catalysts are immediate. CPI in 5 days, medium impact. FOMC in 12 days, medium impact. Higher rates equal higher discount rate, crushing growth valuations. Options market shows put-call ratio 0.76. Neutral positioning, no strong directional hedge from institutions. Yet insiders are strong selling. MSBR minus 100. Analysts are 91% buy rated. A stark divergence between insider selling and analyst optimism. P/E 38 times on 6.7% revenue growth. For the long-term investor, insider selling at these multiples with negative earnings surprise is a red flag. Wait for fundamental stabilization. For the trader, oversold bounce candidate if CPI comes in cool, but insider selling is a headwind. Watch the put-call ratio for a shift toward puts as a signal of institutional hedging. Next, UTI. The other UTI, ticker UTI, down 13.55% today, 17% on the week. Also the worst in its peer group. Similar macro drivers. Rates, earnings, sector rotation. Same macro catalysts. CPI in 5 days, FOMC in 12. Analyst consensus strong buy, 91% buy. But earnings track record. 3 of 4 beats. Last surprise, negative 55%. Insider sentiment. Strong selling, MSBR minus 100. P/E 38 times. Revenue growth 6.7%. Options put call 0.76, neutral. For the long-term holder, the divergence between analyst optimism and insider selling at elevated multiples warrants caution. For the trader, watch the CPI print. A cool print could spark a sharp short cover rally, given the heavy insider selling implying limited downside conviction from insiders themselves. But the negative earnings surprise history suggests caution on any bounce. Now Bitcoin, 64,556, down 0.25% today, up 1.25% on the week. Ranked 3rd of 4 in its peer group. Ethereum up 1.44, BNB flat, Solana down 1.13. Bitcoin is underperforming Ethereum and BNB, showing relative weakness. Upstream, mining hardware and energy. Downstream, DeFi, payments, store value. Watch mining capex and energy costs for upstream pressure. Watch DeFi TVL and payment volumes for downstream demand. Macro catalysts, FOMC in 12 days, high impact. Rate cuts are risk on for Bitcoin. Hikes mean dollar strength and BTC pressure. CPI in 5 days, medium impact. Bitcoin's inflation hedge narrative correlation is unstable. This content is for educational and entertainment purposes only. It does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions.